China's economy got off to its slowest start in at least 10 years. But the GDP growth of 6.4% in the first quarter is within the government's target range. It's also higher than what most economic observers had expected.
The national economy performed within an appropriate range in the first quarter, sustaining the momentum of progress, which will lay a sound foundation for stable and healthy economic development for the year.
The biggest boost came from the manufacturing sector. Its output increased by 8.5% in March alone. In a sign of rising consumer confidence, retail sales also surged 8.7%, while investments into fixed assets like real estate increased 6.3% during the first 3 months of the year. But economists say this growth spurt comes at a price for the government. It's cut taxes for the manufacturing sector from 16% to 13%, while duty on transport has been lowered from 10% to 9%. These and other tax breaks will cost the government about $289 billion. That would keep its budget deficit, the gap between what Beijing spends and earns, at 2.8% of GDP this year. To help plug this hole in its finances, the government's opening up China's $13 trillion bond market to foreign buyers. But analysts say international investors will want more transparency from the government and the private sector if they're going to bet on Beijing. Mobin Nasir, TRT World.
And let's get more on the story now from Martin Jacques, the author of the book When China Rules the World. He joins us now from London. Good to have you back on the program, Martin. As we heard, China's economy grew a little faster than expected. It achieved a similar result in the previous quarter, the last quarter of 2018. Is China's economy out of the woods?
Well, I'm not so sure it's ever been really in the woods, but it's gone through these phases of being a little bit stronger or a little bit weaker. I mean, compared with the last quarter a year ago, equivalent quarter, the growth rate now of GDP is up from 6.3 to 6.4%. I think that the situation is okay for China. I mean, it's been walking this tightrope. It did want to reduce the debt. The debt doesn't threaten China in a big way, but it is a problem because it means that some firms are not able to operate properly. And on the other hand, it is to keep the growth rate up. And clearly, they're managing to do this. 6.4% is not a bad performance. A lot of countries would give their right hand for it.
Yes, now Beijing quickly swung into action last year in an attempt to, boost growth across the economy. It introduced tax cuts and also rolled out a lot of money for infrastructure across the country. Is this result perhaps a vindication of the measures that it took last year?
Yeah, I think that's the correct way of looking at it. I mean, of course, the other thing is that, there's been quite a lot of criticism within China of the government's attitude towards the private sector. And one thing they were doing in the back end of last year and early this year is to try and give more support to the private sector. The tax cuts certainly are going to help it. The shift to some extent in bank lending and so on is also going to help. And the private sector is a very important driver of the Chinese economy.
Let's talk a bit more about China's debt. I think many analysts were concerned that it was spending way beyond its means and therefore it introduced some measures to boost its revenue. But as we heard in Mobin's package, it's also looking to roll them back now in an attempt to boost growth. Is China in danger of falling back into a possible debt trap?
No, I don't think China's ever been in a situation where it was falling into a debt trap. I mean, you've got to remember that basically the only sector of the economy that's really affected by this is in some degree the corporate sector. And that is concentrated in the state-owned companies. But the state-owned companies can always be easily bailed out by the banks because the banks are very profitable. And also the government has got very big reserves and the country's got huge reserves. And the savings ratio in China is still very high. So we're not talking about a country facing the kind of debt problem that's existed in some developing countries, or for that matter in the United States, leading up to the financial crisis.
Now, despite this positive result, the growth rate falling within the 6.5% target range as set by Beijing, the pace of growth is still the slowest that it's experienced in 30 years. What more do you think does the government need to do in order to keep up that pace of expansion?
Well, I think that 6.4% is within the spectrum of what their intention has been. And I mean, there's going to be no return to those extraordinary growth rates up until about 2010, 2011, 2012. When the economy was growing, we grew at 10% for 35 years. And the reason for that is quite simple, and that is China has reached a point now where some of the drivers of that kind of extraordinary growth are no longer possible in the way that they were previously. The two key factors here, I think, is that basically that cheap labor supply has dried up because, the people that were migrating from the countryside, the young, really there's very few left. So therefore, there's a tightness in the labor market that there wasn't before, and that is not going to change. And secondly, the other problem is that China is now, in many areas, an increasingly innovative and sophisticated economy. It can't rely on catch-up anymore. It can't rely on existing technology. It has to invest large amounts in research and development. So on the way forward, what we can expect maybe is the Chinese growth rate will carry on, if it's successful, at a rate of somewhere about what it is now until maybe something like 2025. And then I think from then on, the Chinese economy will be growing at more like 5%. But you've got to remember that this is still an extraordinary growth rate for a country which is now, the second largest economy in the world, will soon be the largest economy in the world. And 6.4% on the present size of the economy is hugely bigger expansion than when, say, 10 years ago, or let alone 20 years ago, when the Chinese economy was growing at 10% a year.
Okay, Martin Jacques, we'll have to leave it there, but thank you again for your time.